Hello viewers, welcome to my channel. I'm Hasham. So this is the third part of the theory of ratio analysis. Last two videos I have prepared on the complete theory regarding the meaning of the term ratio, ratio analysis, advantages, limitations and classification of ratio. This I have discussed in the first part. In the second part I have given the ratios of liquidity ratios and solvency ratios. The four liquidity ratios I have explained in the last video. Those are current ratio, current assets by current liabilities. Then quick ratio, quick asset by current liabilities. Absolute liquid ratio, absolute liquid assets by current liability. Then basic defensive interval ratio. These four ratios are regarding liquidity ratios. Then I have discussed about solvency, leverage or capital structure ratios. So six capital structure ratios I have explained you: debt equity ratio, then proprietary ratio, capital gearing ratio, fixed assets ratio, interest coverage ratio and dividend coverage ratio. These six formulas I have given in the last session, last video. So now I am going to discuss the remaining ratios regarding activity or turnover ratios and profitability ratios. So watch this video till the end, because if you watch this with concentration, then you don't find any difficulty in solving the problem. All the problems are based on the formula and significance of the formula. So again and again, 2-3 times if you watch these starting videos, then definitely you will find it much easier while doing the problems. So don't underestimate, don't neglect these theory videos. So before this video, already two videos I have uploaded. If you have not watched, I suggest you to go to the playlist of my channel. Select the subject financial statement analysis. Select the topic ratio analysis. Watch the first and second video, then you start continuing this third video. Now in this video, I am going to explain you about activity or turnover ratios. These ratios measure the efficiency or effectiveness with which the firm manages its resources and assets. That means how effectively the business is managing its resources or assets. That we can be able to know by applying activity or turnover ratios. So totally again 6 ratios are there. First 4 ratios in liquidity, 6 ratios I have given in leverage or capital structure, and again 6 ratio in the activity or turnover. So you have to remember all the formulas. First activity ratio. Inventory turnover ratio or stock turnover ratio means same. We can call it as inventory turnover ratio or we can call it as stock turnover ratio, means same. The meaning of this inventory turnover ratio is how many times in a year the stock is converted into sales. The stock is converted into sales. That is stock turnover ratio. Suppose if the stock turnover ratio is 6. Suppose if the stock turnover ratio you are getting 6. That means in 1 year. In 1 year, 6 times you are converting your stock into sales. 6 times means every 2 months. Because year consists of 12 months. So every 2 months you can be able to convert your stock into sales. Suppose if I am a businessman, I have purchased the stock for the purpose of sale. So in 2 months I can be able to convert my stock into sales. That is stock turnover ratio. So a higher stock turnover ratio indicates that my stock is converted into sales fast. Quickly I can be able to convert my stock into sales. If the stock turnover ratio is very less, very low, that means very slowly my stock is converted into sales. Sales are very slow. That is the meaning of stock turnover ratio. Now how to calculate the stock turnover ratio? The formula is cost of revenue from operations. Cost of revenue from operation, or in simple words you can say cost of goods sold. We can call it as cost of goods sold or cost of revenue from operations divided by average stock. Cost of goods sold divided by average stock. or cost of revenue from operation divided by average stock. Now what do you mean by cost of revenue from operations? Revenue from operations minus gross profit. Revenue from operations minus gross profit. Actually, what do you mean by revenue from operation? It is sales. Revenue from operations are nothing but sales. So sales minus gross profit, you will get cost of goods sold. You will get cost of goods sold. And average stock, the meaning of average stock is opening stock plus closing stock divided by 2. Divided by 2. Now note, if information is not given, then we can also apply the following formula. Sometimes lack of information, because average stock we can calculate only when opening stock, closing stock both are given. In many problems, opening stock will not be given. When opening stock is not given, we cannot calculate average stock. In that case, the denominator will take closing stock. So instead of average stock, we can take the denominator closing stock. Similarly, numerator, the cost of revenue from operations. The cost of revenue from operations we can calculate if gross profit is given. Suppose if gross profit is not given, we cannot calculate cost of revenue from operation. In that case, the numerator we can take cost of operation, revenue from operations, sales. Numerator we can take sales. So alternative formula, in emergency, if there is lack of information, we can take sales by closing stock. Sales by closing stock, or revenue from operations divided by closing stock. But this alternative formula we can apply only in lack of information, situation of lack of information. If we have complete information, original formula, cost of revenue from operation divided by average stock, or sales divided by average stock. That's it. This is the formula. This is the formula regarding inventory turnover ratio. The second ratio is, one more thing, stock turnover ratio can also be expressed in terms of number of days. Number of days. Instead of calculating times, here stock turnover ratio you will get in times. 6 times, 4 times, 10 times, like that. This formula will give you in times. Suppose if you want the stock turnover ratio in days, then you can convert that formula. That is called stock velocity or stock collection period. The number of days in a year divided by stock turnover ratio. Whatever stock turnover ratio you got, that will take in denominator, numerator, number of effective days in a year. You will get the stock turnover ratio in number of days, velocity. Now, an inventory turnover ratio of 8 is considered ideal. Normally it is considered as 8. 8 inventory turnover ratio is ideal. If it is more than 8, it is very good. Then receivables turnover ratio, second activity or turnover ratio. First turnover ratio I have explained about inventory turnover ratio or stock turnover ratio. The second activity ratio is receivables turnover ratio or debtors turnover ratio. We can call it as receivables turnover ratio, or we can call it as debtors turnover ratio. So what is the formula for receivables turnover ratio? Credit revenue from operations. Actually, revenue from operation means sales. Revenue from operation means sales. So credit sales. Credit sales divided by average debtors or average receivable. So receivables turnover ratio is equal to credit revenue from operations divided by average receivable, or we can call it as net credit sales divided by average debtors. And one point you have to remember, receivables include debtors and bills receivable. So in this formula, when we call receivables, receivables include both debtors as well as bills receivable. And debtors should be taken at gross value before deducting provision for doubtful debts. So debtors should not be taken at net value, it should be taken at gross value before deducting provision for doubtful debts. If the average debtors cannot be found out, then take closing debtors in denominator, just like the stock turnover ratio. Actually, average receivable means matlab opening receivable plus closing receivable divided by 2, or opening debtors plus closing debtors divided by 2. Suppose if opening receivables are not given, we cannot calculate average. In that case, denominator will take closing receivables. So receivable turnover ratio can also be expressed in terms of number of days. That is debt collection period. When you calculate the receivables turnover ratio in number of days term, it is called debt collection period or average collection period. debt collection period or average collection period. The formula is number of days in a year divided by debtors turnover ratio or receivables turnover ratio. The number of days in a year divided by receivables turnover ratio will give you debt collection period, DCP, debt collection period. So, what are the formulas we have seen so far? Activity turnover ratio, first inventory turnover ratio, cost of goods sold divided by average stock, or cost of revenue from operations divided by average stock. This is the original formula. Second, receivables turnover ratio. Receivables turnover ratio, credit revenue from operations divided by average receivable, or credit sales, net credit sales divided by average debtors. If you want in number of days in a year divided by debtors turnover ratio, debt collection period. Two formulas I have completed. Now third formula, payable turnover ratio. Payables का मतलब creditors. The meaning of payables is creditors. So creditors turnover ratio, just like debtors. Just like debtors turnover ratio, we have creditors turnover ratio. The payables turnover ratio is equal to net credit purchases divided by average payable. Net credit purchases divided by average payables. Payables include creditors and bills payable. Just like debtors. Debtors include, receivables include debtors and bills receivable. Receivables include debtors and bills receivable. उसी तरह payables includes creditors and bills payable. In case of average payable cannot be calculated, then we take the closing payable in denominator. In denominator we have average payable. Average payable can be calculated when opening payables and closing payables both are given. In many problems, opening payables will not be given, so we cannot calculate average payable. In that case, denominator will take closing payable or closing creditors. So, net credit purchases divided by closing creditors. If we cannot be able to calculate average, the emergency form. Now, payables turnover ratio can also be expressed in terms of number of days taken by businessman to pay off its debt. That is debt payment method. This is debt collection period. Debt collection period. Now, debt payment period. Now, debt payment period, if you want to find out number of days, the number of days in a year divided by payables turnover ratio. Payables turnover ratio. That's all. Next ratio is working capital turnover ratio. Working capital turnover ratio. The formula is cost of revenue from operations or cost of goods sold. Both means same. We can call it as cost of revenue from operations or cost of goods sold divided by working capital. The formula for working capital is current assets minus current liabilities. So current asset minus current liability, you will get working capital. So cost of goods sold divided by working capital, you will get working capital turnover ratio. So if COGS is not given, then we can take sales in numerator. Suppose if in the if the information in the problem is not given regarding COGS, then in that case we can take sales in the numerator. But that is emergency. If information is not given, then we can take sales. If information is given, then we should take cost of goods sold in numerator. Next formula is fixed assets turnover ratio. Fixed assets turnover ratio, sales, net sales divided by fixed asset. That means how many times our sales are according to fixed asset. In terms of fixed asset. For example, fixed asset are 1 lakh and sales are 2 lakh. So we can say 2 times. Fixed asset turnover ratio is 2 times. Our sales are twice of the fixed asset. The next one, total assets turnover ratio. The formula is net revenue from operations divided by total assets. Net revenue from operations means net sales. So net sales divided by total assets. That's all. So these are the 6 formulas. Which formula? Activity or turnover ratios. So far I have completed 4 formulas in liquidity ratio, 6 formulas in leverage or capital structure ratio, and 6 formulas in activity or turnover ratios. Just briefly we'll recap. The first 4 ratios in liquidity ratios: current ratio, quick ratio, absolute liquid ratio, and basic defensive interval ratio. 4. 6 ratios are leverage or capital structure ratio: debt equity ratio, proprietary ratio, capital gearing ratio, fixed assets ratio, inventory turnover, that is interest coverage ratio and dividend coverage ratio. These are the 6 formulas we have applied in leverage or capital structure ratio. Now 6th ratio I have explained you about activity or turnover ratio. How effectively the business has utilized its resources. This we can test by using activity or turnover ratio. The first activity turnover ratio is stock turnover ratio or inventory turnover ratio. Cost of goods sold divided by average stock. Then second one, receivables turnover ratio. Receivables turnover ratio or debtors turnover ratio. Net, that is credit revenue from operations. Credit revenue from operations or credit sales. Net credit sales divided by average receivable. Divided by average receivable, or simply net credit sales divided by average debtors. Debtors and receivables mean same. So receivables include debtors as well as bills receivable, right? And if you want the debtors turnover ratio in number of days, we call it as debt collection period. The debt collection period is equal to number of days in a year divided by debtors turnover ratio. Now payables turnover ratio or creditors turnover ratio. Net credit purchases divided by average payables. If opening payables are not given, we cannot calculate average payable. In that case, we will take denominator closing payables or closing credits. If you want in number of days, that means debt payment period. Debt payment period is equal to number of days in a year divided by payables turnover ratio. Next, we have discussed about working capital turnover ratio. That is cost of goods sold divided by working capital. Cost of goods sold or cost of revenue from operations means same, divided by working capital. Working capital means current asset minus current liability. Then fixed assets turnover ratio, net sales by fixed asset. Total assets turnover ratio, net revenue from operations divided by total assets. So now we will start the last and final type of ratios, that is profitability ratios. The previous video we have completed liquidity ratio, leverage or capital structure ratio and activity or turnover ratios. The 3 types of ratios we have completed. Last and final, profitability ratios. The ratios which measure the profitability of the concern are called profitability ratios. Now profitability can be ascertained either comparing with the investment or comparing with the revenue. So when we compare it with the revenue, we'll get general profitability ratios. When we compare the profit with the investment, we'll get the overall profitability ratios. So we divide the profitability ratios into 2 categories: general profitability ratios and overall profitability ratios. General profitability ratios means the profit is compared with the revenue or profit is compared with the sales. And overall profitability ratios, profit is compared with the investment. Profit is compared with the assets. So first of all, we'll discuss about general profitability ratios. The 5 general profitability ratios are there. First one, gross profit ratio. The very commonly used profitability ratio is gross profit ratio. The formula is gross profit by net sales into 100. Gross profit by net sales into 100. A higher gross profit ratios is better. So gross profit, how to find out the gross profit? Revenue, net revenue from operation minus cost of revenue from operation. Net revenue from operations minus cost of revenue from operation. In simple words, we can say sales minus cost of goods sold. Because revenue from operation is nothing but sales. Revenue from operation means sales. And cost of revenue from operations means cost of goods sold. So we can call it as gross profit is equal to sales minus cost of goods sold, or cost of goods sold is equal to sales minus gross profit, or gross profit is equal to sales minus cost of goods sold. So remember these formulas. Remember the formulas. So gross profit, net revenue from operation minus cost of revenue from operation, or gross profit is equal to sales minus cost of goods sold, like that. Next, second general profitability formula is net profit ratio. First one, gross profit ratio. Second one, net profit ratio. Net profit divided by net sales into 100. Net profit divided by net sales into 100. This is the second general profitability ratio. Third one, operating ratio. Operating ratio is equal to operating cost divided by revenue from operation into 100. Revenue from operation means sales. On operating cost divided by sales into 100. So what do you mean by operating cost? Cost of revenue from operation plus office and administration expenses plus selling and distribution expenses. In simple words, cost of goods sold. This cost of revenue from operation means cost of goods sold. So cost of goods sold plus office and administration expenses plus selling and distribution expenses. This is called operating cost. So what are the costs which should not be included? Selling cost, financial expenses. Financial expenses and abnormal losses should not be taken in operating cost. Next comes operating profit ratio. The operating profit ratio is equal to operating profit by revenue from operation into 100. Revenue from operation means sales. The operating profit divided by sales into 100. So operating profit means gross profit minus operating expenses or operating cost. Then expenses ratio. Any expense like salary, rent, etc. we can calculate the ratio for any expense. So ratio will be expenses divided by revenue from operation into 100. So 5 formulas I have given for general profitability ratio. Gross profit ratio, net profit ratio, operating ratio, operating profit ratio and expenses ratio. These 5 ratios are called general profitability ratio. Now overall profitability ratios. These ratios are the profits are compared with the investment. So first overall profitability ratio, very important ratio is return on capital employed. It is called ROCE or return on investment, ROI, both means same. We can call it as ROCE or we can call it as ROI, return on capital employed or return on investment. The formula is PBIT, profit before interest and tax divided by capital employed into 100. This formula will give you the overall profitability on investment. Investment includes all investment whether by the owner or outsider. That's why we use capital employed. What do you mean by capital employed? Equity share capital plus preference share capital plus reserves and surplus plus long-term loans and debentures. So even outsider fund, these long-term loans and debentures are outsiders funds, minus fictitious assets, minus non-operating assets. So by using this formula we can find out capital employed. So what is the formula for ROCE or ROI? PBIT divided by capital employed into 100. And capital employed is equal to equity share capital plus preference share capital plus reserves and surplus plus long-term loans and debentures minus fictitious assets minus non-operating assets. This is the first formula, overall profitability ratio. Second is return on net worth. Net worth means shareholders fund. So PAT, profit after tax divided by net worth into 100. Net worth means shareholders funds. And already you know shareholders fund, already previous formula we have applied. Equity share capital plus preference share capital plus reserves and surplus minus fictitious assets. That is called shareholders fund. Now return on equity capital. So return on equity capital, PAT minus preference dividend. If preference dividend is given, then profit after tax minus preference dividend divided by paid up equity share capital. So PAT minus preference dividend divided by equity shareholders, paid up equity share capital into 100. But one more alternative formula is there. Some author says in denominator we should not take paid up equity share capital, we should take total equity shareholders fund. Total equity shareholders fund. Here we have taken only equity share capital in the first formula. Alternative formula is there. In denominator we take equity share capital plus reserves and surplus minus fictitious asset. That is called equity shareholders fund. Equity shareholders fund means equity share capital plus reserves and surplus minus fictitious asset. So denominator is different. Some authors use this formula, other authors use this formula. So we can calculate both, no difference at all. Though we'll get the different answers, but the contention is we can calculate in both the ways. Next, return on total assets, ROTA. Return on total assets. So PAT divided by total assets into 100. Profit after tax divided by total assets into 100. Earnings per share. This is very important. Earnings per share. The profit after tax minus preference dividend divided by number of equity shares. You should not multiply by 100. Whereas other formulas, other profitability ratios, we have multiplied by 100. We get percentage. But EPS is the earnings per share. So don't multiply by 100. PAT minus preference dividend divided by number of equity shares. Then dividend per share, DPS. Dividend per share. Dividend on equity share capital divided by number of equity shares. Don't multiply by 100. Dividend per share. So dividend on equity share capital divided by number of equity shares. Now dividend payout ratio, DP ratio. It is commonly called as DP ratio. So dividend payout ratio is equal to DPS by EPS into 100. Dividend per share divided by earning per share into 100. The next one, price earning ratio. Very important ratio. The price earning ratio is equal to market price per share divided by earnings per share. Market price per share divided by earnings per share. So the inverse of this P ratio will give you earning yield. The inverse of P ratio is called earning yield. So earning yield is equal to EPS by MPS. So PE ratio, MPS by EPS. Earning yield, EPS by MPS. The next formula, dividend yield ratio. Dividend yield ratio. The formula is DPS divided by MPS. Dividend per share divided by market price per share. That is called dividend yield. Last and final formula, book value per share. The book value per share is equal to equity shareholders fund divided by number of equity shares. That's all. So totally 10. 10 overall profitability ratios and 5 general profitability ratios. So 15 ratios. So totally how many ratios we have studied so far? 4 liquidity ratio. Liquidity ratio 4. Leverage ratio 6. Then activity or turnover ratio 6. Then lastly profitability ratio 15. 15. So totally it will become 10, 25, 30, 31. 31 formulas we have seen. So this, yes, 31. Totally 31 formulas. But one of the limitation of ratios are there is no limit to ratios. These are the commonly used ratios. These are the minimum ratios which every student must know. Apart from that, some more ratios we will come across while doing the problem. So at the time of doing the problem itself, I will derive the formula, what would be the formula for that ratio. But this 31 ratio you have to remember compulsorily. So 4 ratios, current ratio, first ratio, liquidity ratio. The liquidity ratios are current ratio, quick ratio, absolute liquid ratio, basic defensive interval ratio. 4 ratios. Then 6 ratios are leverage or capital structure ratios. The 6 ratios are debt equity ratio, proprietary ratio, capital gearing ratio, fixed assets ratio, interest coverage ratio, dividend coverage ratio. These 6 ratios are leverage ratio. Then 6 are activity or turnover ratio. Stock turnover ratio, receivables turnover ratio, payables turnover ratio, working capital turnover ratio, fixed assets turnover ratio, total assets turnover ratio. 6 formulas. Now 5 formulas are general profitability ratio. That is gross profit ratio, net profit ratio, operating ratio, operating profit ratio, expenses ratio. These 5 are general profitability. Then 10 are overall profitability ratios. The overall profitability ratios are ROCE, return on capital employed, or ROI, return on investment. Then return on net worth, return on equity capital. The next one, return on total assets, return earnings per share, dividend per share, DP ratio. Then price earning ratio. The next one, dividend yield ratio, book value per share. That's all. So I have explained you completely These three videos are very, very important. So I suggest my regular viewers, my students, please watch these three videos not once, twice, thrice. जितना आप ये फर्स्ट थ्री वीडियोस देखेंगे उतना आपको प्रॉब्लम्स पर डिफिकल्टी नहीं होगी. You don't find much difficulty in doing the problem if you invest some time in learning these three videos. So next video I'll start the problems on ratio analysis.